Good morning, all. Let's start with the morning call. Nifty closes flat week-on-week basis. RBI stays on hawkish hold. Nifty valuation is at 20.7 times. That is 1.3 standard deviation. Relative price to earning premium versus over the last 5 months, FPI have been continuously invested in the Indian equities, accumulating a total of nearly $15 billion for this calendar year. Remarkably, each of its past 3 months have seen an inflow surpassing near $5 billion. In these 3 months, the financial has attracted the highest inflows of nearly 35%, followed by the auto, that is 13%, and capital goods at 10%. In contrast, the information technology was the least favored sector during this period, while the chemical was only the sector that saw the meaningful outflow of nearly $120 million. Coming to few results update, starting with ABB India, reported strong earnings, which came at 21% ahead of what the expectation was. The keys standout this quarter were the strong double-digit margin across the segment. EBITDA margin came at 13.9% and robust order inflow. Order inflow came at nearly 30.4 billion rupees, which was aided by the mix of base and the project order. We see ABB India as a strong play on digitalization and automation in India and expect company to report nearly 28 to 29% recurring PAT CAGR of over calendar year 22 to calendar year 25. Info Edge numbers, recruitment segment billing declined 4% YOY, driven by the slowdown in the IT sector hiring and the delayed contract renewals, while the non-recruitment that is billing for 99 acres grew nearly 20% YOY, aided by the demand improvement in the real estate sector, but the segment remained the loss-making. Operational PBT loss of nearly 225 million rupees, while we see Info Edge underperforming on the slower growth for Naukri, no clear path to the profit in other verticals, and markdown risk for the investment book. ONGC reported a sizable 20% beat on standalone EBITDA of 177 billion rupees in first quarter, mainly led by the better than expected realization and lower dry well write-off. PAT has surpassed expectations by 25%, standing at nearly 100 billion rupees. We maintain our positive stance on the upstream sector, mainly on stable earning outlook, attractive valuation, healthy dividend yield. Coming to actionable idea, two actionable ideas we have. First is SJS. Given during the first quarter, the company continued to outperform the underlying industries. Outlook for two-wheeler, PV segment, and consumer durable remain positive, while the acquisition of WPI has added a strong capabilities and is expected to accelerate the growth going ahead. SJS has showcased its outperformance in the past year, and the visible growth trigger are clear for the coming year. We trust that due to its niche business and new product and competent management, the company is able to drive the growth higher than industries. We maintain our buy with the target price of 680 to 690. Second is BPCL. First quarter standalone EBITDA was significantly higher at nearly 158 billion, which was both higher than our and consensus estimate, due to reported GRM being significantly higher at $12.6 a barrel versus our expectation of $10.4 a barrel. Implied marketing EBITDA was also better than expected. We remain buyer with the target price of 375 to 385 on valuation. If you see, it stays nearly 1.2 times FY25 price to book. And OMC's integrated margin has improved with the moderation crude oil prices and normalization of the product cracks. Right. Lastly, Adani Port will be in focus today and will be also focused in the near term. as the Deloitte has resigned its auditor role for Adani Ports, and BDO, the one of the top 6 global audit firm, has replaced it. Adani Group has had many auditor change recently, but this Deloitte resignation appears to be driven by the inability to sign off certain transaction alert to the related party in the Jan 23 Hindenburg report. While the allegations were denied by the Adani port, the Deloitte resignation may see a correction in the stock, but today we have India's Supreme Court decision on the on the SEBI probe decision into allegation of the Adani Group made in the Hindenburg report. The outcome of SEBI probe is crucial to reinstate the investor confidence and vice versa. But the Adani port is a strategic asset, and if you see on valuation perspective, it trades at steep discount to FY25 price to earning compared to the its peer group Container Corp. That's it. What I have. Will stop here and hand over for further updates.
Thanks, Kaushik. Very good morning, friends. Rahul Sharma this side. Well, it's time to fasten your seatbelts as it is going to be a bumpy ride, especially in the banks and financial stocks. Multiple bearish divergences are seen in mid-cap and small-cap indices. There is a possible breakdown on the Nifty 500 chart as well. Plus, there is a bearish head and shoulder breakdown in the Nifty versus Dow chart, which means that we could underperform the US markets for a few days from here. And there are multiple indicators that are suggesting that the impending down move may take place in the next few days. Now, who are shorting the market? So, FIs have maintained their short positions in the index futures. In fact, in the last 3 trading sessions in the previous week on Wednesday, Thursday, Friday, they have progressively added their shorts. And the Friday's figure in the cash segment was the highest in last many months, especially after the market's turnaround. So around 3,073 crores of sell figure was seen in the cash segment along with a bearish outlook on the index futures segment. Retail has been continuously long and they continue to hold around 52,236 contracts on the long side as on Friday. On the derivative side, there was short build-up seen in Bank Nifty in the last 3 trading sessions as it slid from 44,975 to 44,120. The OI is up 17% week on week. What has also happened is even FinNifty has attracted shorts with the open interest shooting up by 52% in the same period. And the put call ratio has dropped to 0.52, down 37% week on week. So clearly both the indices, which is Bank Nifty and FinNifty, are in the bear grip along with the closure of both the indices below the 50-day moving average, and this has happened for the second time in this month. Most of the sectors remain under pressure in the previous week except IT, metals, capital goods and textiles. Week on week, longs were seen in Dr. Reddy's, Reliance, Adani Ports and SBI Life, whereas shorts were seen in Britannia, Kotak Bank and Bajaj Auto. Coming to the weekly view for the Nifty. So ideally, the bias is bearish as long as we remain below the 20-day moving average of 19,544. We can expect a fresh breakdown in case 19,295 is broken. So 19,295 is a triple bottom support for the Nifty. In case this level gets broken, we may head towards lower levels of 19,160 and 19,000 on the downside. For bulls, 19,645 needs to be taken out decisively for any kind of challenge to the short setup of the market. Clearly, repeating, Bank Nifty and Nifty are in bear grip and can witness more downside in the coming week. Now, which are the stocks which could lead this down move? So on the meltdown stocks, we have 2 ideas. One is Bajaj Finserv. It has been forming a bearish pole and flag pattern on the daily charts with multiple supports in the area of 1470 to 1495. Well, if this level gets challenged, this area gets broken, we could very well see the stock heading towards 1440 and 1400 on the downside. Apart from that, HDFC Bank, which is the heavyweight in the banking index as well as in the Nifty index, could see further downside as it has breached its 100-day moving average of 1640 and can test 1579, which is the June low, and can even trade lower if that low also gets broken. So around 40-point downside is on an immediate basis in HDFC Bank, and around a 100-point downside can be expected in Bajaj Finserv. Now, which are the stocks which look good on the long side? One stock which could clearly limit Nifty's downside is Reliance. So Reliance has been the only stock along with the IT index which could do so, and we can expect a breakout in case 2559, where a double top is there, is taken out. We could very well see it heading towards the 2630 to 2650 mark on the upside. Metals continue to remain strong, and Hindalco is our favorite pick at these levels. If 471 gets taken out, we can very well see the stock heading towards the 500 territory. On the IT space, the risk reward is very favorable in TCS and could be looked upon for trading on the long side. As far as the macro view is concerned, we advise to add on the possible correction that can come in this week. The levels on at where one can look to add. One is 19,295, which is the triple bottom. Most probably this should get broken. Below that, 19,160 and 19,000. These are two levels where one can look to add long positions for targets, for medium-term targets of 20,200 and year-end targets of 20,800 and 21,000 on the upside. IT, PSC, and metals are the favored sectoral bets which look good technically for the rest of this calendar year. And we maintain an underperform rating, a technical underperform rating on banks. And as we have also shared the IT basket is already in the green in a week where Bank Nifty was struggling to find its feet. And we expect this setup to continue where IT outperforms and banking continues to underperform. So that's it from my side. I hand over the call for further updates. Thank you.
Thank you, Rahul. Good morning, all. Jay this side for the currency and commodity update. The US PPI improved to 0.3% on month-on basis and 0.8% on year-on-year basis for the July, against 0% in the prior month. The core PPI represented 2.4% yearly figure for the July compared to expectation of 2.3%. Now, the dollar index witnessed a bounce back on back of a firmer US bond yields as well as the geopolitical concern about the China and Russia. Also, the looming bond default from the China challenged the sentiment and allowed the US dollar to cheer its heaven status. China allowed the local government to use the provincial level governments to raise around 1 trillion yuan, or I can say $139 billion via bond sales to repay the debt of local government financing vehicle and the other off balance sheet issuer. So overall, the dollar index is moving higher and it is expected to move higher further towards 104 levels in this week, while on the downside support can be seen around 102 levels. While the USD INR future gained by around 50 paisa or 15 paisa on Friday and formed a green candle on the daily chart, but it remained range bound throughout the week and ended the week with a marginal loss. Though the USD INR is hovering around 82.80 levels from last few days, the 8250 call writers, where the highest open interest is, are still holding their positions, which indicates a still resistance around 82.85 to 82.90 levels. While the highest put open interest is placed at 82 put options. So the option writers are still holding the position, which indicates that there is a possibility that at higher levels we can see a selling pressure. Also, technically, 83.10 on the spot has been acting a crucial hurdle from last 10 months. And until and unless that gets crossed, it's better to remain either on the sideways or one can take a put options of the USD INR. But one need to remember that once a breakout comes, the short covering move will be very, very fast, and above 83.10, one should not remain on the short side in any kind of positions. We can see a move up to around 83.50 or 83.70 kind of level within a day or two once the breakout comes above 83.10. On the commodity space, precious metals remained sideways on Friday and ended on a flattish note. On week basis, gold was down by around 0.33%, while the silver underperformed and posted a loss of 3.5% last week. Gold is expected to remain in the range of 58,600 to 59,500, and there are no major triggers for the gold prices at current levels. While the silver formed two doji candles on the daily chart around its support levels, which indicates indecisiveness among the traders, and after the corrective move, doji candles can be a sign of reversals. Till the time it holds above the support of 69,000, there is a possibility of a bounce up to around 71,500 to 72,000 levels in this week. Crude oil gained by nearly 1% on Friday, while it continued the bullish momentum for 7th consecutive week and formed green candles on the weekly scale. Since it rallied a lot, a pullback move cannot be ruled out from the higher levels. But till the time we don't see any major sign of reversals, it's better to trade with the trend, which is definitely on the upside. Right now, support is placed at 6,850 to 6,800 levels, and any dip towards the same can be used as a buying opportunity. And it is better to trade with a call option of 6,900 strike. On the upside, 7,050, 7,100 can be possible in this week. So that's it from the currency and commodity side. Now we are open for Q&A.